A very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Coghlan. I hope everybody's doing well. Looking forward to this session. One of the most hotly anticipated central bank meetings that we've had so far this year and likely to set the near-term direction. So very, very important meeting. Just as other folks are signing in, very good morning, good afternoon to you. Don't forget, as we look at different entries, different exits, the whole idea of this workshop is that you're looking over my shoulder, seeing my expectations, and that is from an educational perspective rather than a signal trading service. Those of you who attend regularly know exactly how this works. And of course, today's workshop is getting ready for the Fed. So I'm going to outline to you my three-step process before risk events, which is 1, what's the base expectation? 2, what will be the surprise announcement? And then 3, what's the bigger picture? Now, what we need to do is, first of all, just remind ourselves exactly where we're at with the Federal Reserve. And the best description that I can have for this, there's 2 ways of describing the current dilemma. The first way is just seeing the differences between what the Federal Reserve said in December's meeting. Remember, the last dot plot we had was in December. We don't get a dot plot at this meeting. It comes at the March meeting. So there won't be a dot plot, but the last dot plot saw the blue dots here, which indicated not a single rate cut all of this year. But if you look at what the market expectations are, you can see the market expectations have been superimposed onto the Fed's dot plot. And you can see that really market's expecting, interest rates to be around 4.5%, sub 4.5%. So what short-term interest rate markets are pricing in is 2 rate cuts this year. You can see that very clearly with the short-term interest rate curve. And that's a really helpful curve to look at. So you can see this is the path of interest rates that's being projected by short-term markets. And what they're expecting is a terminal rate of 5%. You can see 4.8, 4.90, 4.91. So terminal rate just under 5, but then a drop back down to around 4.5%. So moves up from current level of 4.375, moving up to 5, May, June, followed by 2 rate cuts to the end of the year. That is what the market is expecting. And you can see that current expectations of 97% chance of a 25 basis point hike. So this is really helpful because it tells us exactly what the expectations are. Everyone is positioned for a 25 basis point rate hike. And if we take a look at the calendar and we look at what economists are projecting, you can see that economists are projecting a move up of 25 basis points to 4.75% from the previous 4.5, right? Now, some maybe see it a little bit higher. So it could be like a 35 basis point hike, or slightly lower, like a 15 basis point hike. So that tells us what the economists' range of projections are. But no one is, but short-term interest rate markets aren't expecting a 50 basis point hike. Okay, you can see they only see 3% chance of a 50 basis point rate hike. So that tells us what the baseline expectations are. Now, what's going to be important for this meeting is not the interest rate decision itself necessarily. Obviously, if there's a surprise, it will be, but the 25 basis point rate hike is fully priced in, okay? Completely priced in. And what will be a surprise will be traders looking at what the forward guidance says. So in other words, what path will the Federal Reserve be saying is going forward. Now, let me explain what the problem is. So first of all, what's been going well? And if you look at the, hang on, where is it? If you look at headline inflation, you can see that's been dropping lower, okay? Month by month, since the middle of last year, the headline inflation for the US is now 6.5%. That ticks a Fed box, so that's been going well. Similarly, if you look at the core PCE index, that's the Fed's preferred measure of inflation. We had another printout for December, just out recently, end of last week, and look, it's fallen to 4.4%. Good. So the good news is the Fed's, at this moment in time, winning the battle against inflation. That is giving the Fed confidence that their interest rate hikes are working. But one of the problems that the Fed stresses is that their labor market is very tight. So a tight labor market means that there is not a big amount of slack in the labor market. Most people are employed, most people are working, and the unemployment rate is quite low. Look, it's only 3.5%. Now the Fed do project this to go up to over 4.5%. So they're expecting it to rise up to sort of year highs. It's not there at the moment. So this is a concern for the Fed. And the reason that's a concern for the Fed is because they want to see less jobs and more people unemployed, because that means that prices will have to start to come down. And it will also mean that workers won't be able to demand so much higher wages. So this, weirdly, you might think, well, why is the Fed concerned with people not being not being unemployed? Because what the Fed want to see is they want to see signs that their hiking interest rates is cooling the jobs market. At the moment, the jobs market is still very tight, it's very hot. In other words, it's going very well. And that's a problem for the Fed, because that is inflationary. Because if there's not that many jobs, if there's not that many workers around, and there's more jobs than workers, the workers can ask for higher wages, and that's inflationary. And if you look at the headline for the jobs, you see that the US has been adding jobs month after month after month. So even in December of last year, the Fed added 220, the US added 223,000 jobs. So the labor market is going very well. And if we look on what's expected on Friday of this month, we've got non-farm payrolls coming up. And if you look at what's expected, you can see that the unemployment rate, okay, it's meant to go up to 3.6%. Okay, that would be some encouragement for the Federal Reserve. And the headline is expected to fall to 185,000. Okay, so 223, so that's 185. So, okay, there's two ways of looking at this data. One, you might look at that and say, yeah, but look, the trend is lower. So, how long will we be before the US starts losing jobs? And we've seen PayPal cut jobs recently. We've seen Amazon cut jobs. Tesla's been cutting prices. Microsoft cut, a lot of big tech names have been cutting jobs. It's been all over the financial media. So eventually that's going to filter its way through to the data. But that's what now you see what the Fed want to see. So the Fed's going to look and say, okay, yes, we're pleased that core inflation is coming down. We're pleased that headline inflation is coming down, but we're concerned because unemployment is still low and the US is still adding jobs. So the problem for the Fed is if they say, okay, if we stop hiking interest rates now, then with a jobs market that's still adding extra jobs, that's going to be inflationary. And if you just look at this, I'll show you another metric that's very helpful. If you look at the average, if you look at average weekly hours, let's see, average hourly earnings, okay? Do you see, right, see how average hourly weekly earnings are still quite high? So they've been rising. Now they are falling lower, but that's still going to be a concern for the Fed. It's showing a tight labor market. So all of that is helpful for us, because what it now shows us is it's not so much the decision that the Fed make, it's what they indicate about their forward guidance. So do the Fed say, yes, short-term interest rate markets are right, we're looking at pausing and then cutting? They're not going to say it like that, but you understand that's what we're trying to interpret. Are they going to say that, or are they going to say this is wrong and you should go back to our dot plot in December and realize that we're not cutting rates all year and we might be holding them at 5 or even higher for the whole year until we're confident that the inflation battle is won? And the inflation battle, you can see, remember, the Fed's target is 2%. So you might look at this and say, wow, yeah, the trend is lower, good. Or you might look at it and say, yes, but we're still triple the target. So there is different ways of interpreting this data depending on your point of view and your perspective. So what we need to see is, what's the Fed going to say? So remember the way this works. You're going to get the decision at 7 o'clock, and then you're going to get the press conference at 7:30. So what you need to be aware of is, yes, you get the decision, but then don't think it's all done and dusted. Don't think, oh, 7 o'clock, they've made a decision and I'm going to trust, what the decision says, because often the press conference can contradict the decision. Now, you might say, oh, why are they doing this? They shouldn't be doing that. Look, markets are tricky, and these guys know that if they say one thing in one direction, the market will run and run and run with it. So it makes sense to kind of say one thing in the statement and then qualify it or even contradict it at the press conference, because it just adds a bit of balance into markets and, gets rid of some of those speculators who are trying to make short bucks. Now, the thing that you can know is that there's short-term opportunities from the decision, but then often that direction will reverse at 7:30. So be aware of that dynamic going on. All right, just be ready for that. So the decision might say one thing, but then the press conference might say another, to kind of like qualify it. Now you know what the big picture is, and this is really what I'm expecting. So this is my outlook. I'm assuming a 25 basis point hike. But if we get a hike and Powell says terminal rate is to be 5.5%, inflation is sticky, and the labor market is still tight, then I expect S&P 500 selling, gold selling, dollar buying. If, by contrast, we get a 25 basis point hike, but then Powell says, expect inflation battle to be won, labor market to slacken, then expect S&P 500 buying, gold buying, US dollar selling. So if Powell sort of indicates, so this top decision with the S&P 500 selling, gold selling, US dollar buying, would be if the Fed's moving back towards that dot plot outlook of December. So no rate cuts this year, inflation is sticky, labor market's still tight, we need to do more. That scenario is S&P 500 selling, gold selling, dollar buying. The other scenario is if they hike but expects inflation battle to be won. So Powell says, really pleased about the headline inflation, really pleased about the really pleased about the core PCE falling lower. We're winning the battle. I expect it to be won. A labor market, we're expecting the labor market to slacken now. Look, yes, we're expected to add 180,000 jobs this month for January, but I'm expecting this to fall into negative shortly. and that would be S&P 500 buying, gold buying, silver buying, dollar selling, euro US dollar upside. That is my outlook. Now, the one thing to look out for is if we got a 50 basis point hike. Markets aren't positioned for that, so that would be sudden euro US dollar selling, okay, and sudden S&P 500 selling, sudden gold selling. So one tactic that I like to use when there's the chance of a 50 basis point hike. Now look, it's short-term interest markets only saying 3% chance of a 50 basis point hike. So it's very unlikely that they do hike by 50 basis points. But if they do, that means everyone's surprised, right? So there's a good opportunity. So what can be done is euro US dollar selling can be done at market. Okay, or you can use this tactic. If you never used it before, you'll have to try it. But this, say this is a surprise 50 basis point rate hike, you could just have a sell on stop at say 1.0870, and you're only going to get triggered in. Say this was just pre-market price. So they say this is like, you know, 6:59 tonight UK time. Then you just have a sell on stop order 35 points below price. Because if there is a 50 basis point hike, the euro US dollar pair will drop 110, 100 plus points in a few seconds. And if you have a sell on stop 35 points below price, normally you get taken in, you get slippage, which is just normal because the market's so fast moving. But even with slippage, and you have to try this if you've never tried this before, maybe you get like 10 to 20 point slippage. But if you had your take profit, like, you know, at 1.0790 or 1.0800, something like that, you can just take, you know, a decent chunk out of the market if you've got a 50 basis point. If you've never done it before, you know, don't try it with a large amount, try it with a very small size, and you can take it from there. Oil markets, if we got reason for dollar weakness, oil markets really nicely positioned here for upside. You've got a Harami inside bar, pin bar inside bar, really attractive for upside breakout here. And I've been covering this on my blog, so do look at the seasonal reasons that I can see for oil upside at the moment. So if we get reasons for dollar weakness, that would be a good time to potentially enter oil markets. That's my perspective. You have to do your own research, obviously, but that's what I'm looking at. And I'm just sending that to everyone in the chat box. And this is some of the reasons I'm expecting for potential upside for oil as we come out of the meeting. So that's definitely one to be looking out for. Okay, folks, are there any questions that you've got? Anything you're not sure on or unclear of? But this is a hotly anticipated decision. So we could see some significant volatility from this. It's definitely something to be looking out for. All right. I think everybody's clear. Okay, folks. Safe trading. Kashif, good to have you here. Kingsley, you too as well. Thanks for making it, both of you. Musab, excellent. Hope that's been helpful. And we'll be due to be back here on Monday. We'll be looking forward to the RBA rate decision next week as well. Okay, folks, take care. Have a very good afternoon. Thanks, everyone now. Goodbye.